Good afternoon, everyone. Welcome to the Singapore Pavilion. This afternoon, we will feature three distinct programs that highlight the different aspects of carbon markets development and sustainable finance. To kick us off, we have the Singapore Financial Sector Carbon Market Innovation Showcase. Earlier today, we saw the strength of collective intent and action in developing energy transition credits to accelerate coal to clean transition. To complement market enablers, we also need innovative financing and risk mitigation tools that address the diverse project needs, institutional challenges, and on-the-ground requirements that hinder capital flows. The next two showcases will shine the spotlight on innovative capabilities from the broader carbon markets ecosystem. Joining us today are WWF International, a global NGO driving advocacy, research, and advancement of nature-based solutions, and Marsh, a global insurer, broker, and risk management advisor. First up for today, we have Mr. Aaron, Global Finance Practice Lead at WWF International. Aaron, please.
Yes, good afternoon, everyone, and really great to be here. And thanks for Marsh for inviting me. I will have a bit of stiff neck because I have to look at my slide that way, so I'll try to manage. So what I want to do today is a little bit, talk about how nature underpins the economy. Also talk a little bit about what WWF is doing about it, because we don't only do advocacy, but we also want to be a part of the solution. So we understand that we have to work with the financial sector, with companies to drive more finance to nature. Yeah? So it's not just advocacy and publishing reports. So this is our storyline, right? So we always say half of the global GDP is dependent on nature. So a couple of years it was still 44 trillion, and I think that was a World Economic Forum figure, but the number is increasing, and probably partly that's because the methodology to estimate is changing, but also weather events are increasing, severity and frequency is increasing. So economies, businesses, they understand that without nature, they will be more impacted, right? So the number is going up. This is also an old figure. This is the nature financing gap, which was also updated a couple of months ago by the Paulson Institute. And the gap has now increased from 700 million to 1 trillion. And the number of money that is flowing to nature is also slightly going up from about 142 billion to 200 billion right now. But we're still looking at a massive gap, and that gap will never be filled by the governments that are negotiating today, and it will also not be filled by philanthropy, right? So we really need to engage business and the financial sector to think about full return models to fill that gap. So this is an overview from UNEP, where they are showing how much good money is in the world and how much bad money is in the world, right? So currently the level of investments in nature-based solutions is around 200 billion a year. And if we want to bend the curve to nature positive, that number needs to triple. Currently, the footprint of the private sector in that 200 billion figure is about 1/3, and the majority is coming from the public sector. But then, on the other hand, the private sector has a big footprint in the money that we don't want, which is the 7 trillion number. So out of the 7 trillion, 5 trillion is owned and managed by the private sector, and it is invested in activities that contribute to degradation of nature and to climate change. So we need to change that. And as I said in my introduction, WWF wants to be a part of the solution. So we have a strategy. We want to contribute to a meaningful shift in finance. And we have two strategies. One is greening finance, and the other one is financing green. So greening finance is really our offer to the financial sector to transition towards nature positive and net zero ways of investing. So there's a whole suite of frameworks that we help develop. SBTI, the Task Force on Nature-Related Financial disclosures. We're working with regulators. So there's a lot of what we do on greening the financial sector. But then on financing green is really to mobilize more capital to the places where we have been doing conservation for the past half of century. And unfortunately, the curve of nature decline is still going down, and we have to scale and accelerate conservation with the help of more capital coming from the private sector. We have 4 pillars of work. So the first pillar is green finance for landscapes or seascapes. So we really need to move away from transactions and take a geography where nature exists, where people live, where businesses produce, and think, how can we drive sustainable finance to these geographic areas? Then the second work stream is green financial solutions, which is the whole suite of products that are now emerging in the financial market. So think about nature credits, carbon credits, blended finance, TFFF, which is launched at COP today, right? Then we work a lot with central banks, financial regulators, that's greening financial systems, and we work with individual financial institutions, which is greening financial institutions. So a little bit on the sustainable finance for conservation landscape work. We have a playbook, which is really a step-by-step approach, how you can drive more money to these places. And for the ones that are interested, on Friday we're launching a 20 billion initiative to drive more money to these landscape seascapes. It's happening in the Panda Hub, the WWF Hub, around the corner, 11:30. Be there. So now moving to blue carbon and moving to Asia. So we have a so-called blue carbon initiative, and that's really initiated because of a couple of trends that we see happening when it comes to mangroves, right? So if you look at the Southeast Asia region where Singapore and MAS is situated, you see that 30% of the mangroves have been lost due to illegal agriculture and agricultural practices. So conversion from mangrove habitats to agricultural and aquaculture habitats. And then, of course, there have been many efforts to restore mangroves in Southeast Asia, but the bad news is that 50% of these projects have failed, so have not been successful. And a big cause of that is because these were ill-designed, so not really done in partnership with local communities, really tapping into the local knowledge of local communities. So WWF wants to learn from these failures and do it better in the coming years. So why are mangroves such important ecosystems, right? So for starters, they're big sinks of carbon. They store 4 times more carbon than tropical forests. And if you would cut 1% of the mangroves in the world, that would release the amount of carbon equal to 50 million cars, right? So they're big carbon sinks. But they also are very important for the livelihoods of local communities. They are spawning areas for fisheries, right? But they also provide resilience against climate change for these local communities. But then, of course, that's why WWF is so interested in mangroves, is they are spawning areas. So they're the breeding grounds for tuna, for all kinds of marine species. So they contribute to the diversity and abundance of marine ecosystems. So the mangrove breakthrough was launched at COP28, which said that we need to mobilize 4 billion for mangroves in order to restore 50 million of hectares. And WWF wants to contribute to that mangrove breakthrough. I think at COP30 there are a couple of mangrove breakthrough sessions, and I'm happy to guide you to these sessions as well. So what we have in mind for the Southeast Asia ASEAN area is to set up a mangrove blue carbon fund where we have a stepwise approach. So we will start in the coming year with testing how we can restore mangroves, learning from the failures in the Philippines and Indonesia, and we will deploy philanthropic money to really test the models and to make sure that we're getting it right this time. So we will do that in 2 countries. In parallel, we will set up an investment fund that is securing investments that we can provide to local communities and project developers to restore mangroves. So we're looking at a restoration of around 6,000 hectares in the years ahead. We will then expand to countries like Vietnam, Malaysia. And then by 2030, we want to increase that number to 12,000 and even move to the Pacific area, so countries like PNG and Fiji. This is how it then fits in this landscape approach. So we're not going with transactions, but we really want to see how this mangrove protection fits in this seascape approach. So this is the Sulawesi marine corridor, which is very important for migration of fish, including tuna. And by restoring these mangroves, we are contributing to the restoration of this blue corridor that goes all the way from the Philippines to Indonesia. This is my last slide. I hope I'm still in time. So we will scale investments in blue carbon and in mangroves. And we foresee that we, in the coming couple of years, with this fund, we have a couple of important impacts. So for starters, we will restore 12,000 hectares of mangroves, right? And that will also contribute to the restoration of key marine species in these areas. But then, of course, we always take the social dimension into consideration. So we also aim to improve the livelihoods of around 500 communities in Southeast Asia, in the countries which are mentioned. Then on top of that, we're aiming to store about 1 million of tons of CO2, which I just calculated equals 200,000 cars emissions annually, right? That makes it more manageable. And then, of course, you have a lot of... So WWF is not a project developers. There are already project developers that are very active in this space. So we will invest the funds that we raised to support these companies to be more successful and effective in mangrove restoration. Thank you. All right. Are there any questions? I went very fast. All good? All right.
Thank you, Aaron, for showing us WWF efforts in building a blue carbon ecosystem. It is not an easy feat, and I'm heartened to hear about the progress that you have made. Thank you. Next up, we have Ms. Amy, Global Head of Energy and Power and Head of Climate and Sustainability Strategy at Marsh. Amy, please.
Thank you very much. And I need to start with a thanks to Singapore and to MAS in particular for the catalysing role you have in bringing finance and nature together. So thank you for hosting this event and having me here. Insurance doesn't get everybody excited. I realise that. But it is really important. And I was really heartened to hear Mia Motley say, I think it was last year, that if something isn't insurable, it isn't bankable. And that's why it's so important that we think about risk and the risks that may deter private capital for coming into carbon markets. So first of all, I'm going to scene set a little bit about the role for insurance in transition generally, and then I'll get specific into carbon. So insurance has a really important role around the transition. There are things that we can do, from taking existing products to risks that we don't understand well. So I'm sure everybody here knows that risks are priced based on what happened in the past. Well, for a lot of new technologies, we don't have a past to look at. Now, that can be for things that may sound as straightforward as building with low-carbon building materials. But we don't understand what will happen with cross-laminated wood. Not in fires. We're not really worried about wood in fires. We're worried about it in floods. How does it cope with inundation? How do you ensure that? How do we think about the insurance for low-carbon cement? We don't know how that's going to perform in 30 years' time. So how do we make sure that's insurable, as buildings won't get built unless that happens? So these are products that are well understood, but for new technologies. We also need to think about the financial systems that we operate in. In some jurisdictions, such as in the United Kingdom, you can use credit insurance to lower your cost of capital. Not all jurisdictions allow that at the moment, but we can actually bring down overall project costs by using credit insurance and other financial instruments. So in the jurisdictions which allow that, How do we scale it? And in the jurisdictions that don't, how do we advocate for that kind of relief to ensure more capital flows? And then finally, how do we modify offerings for the future? How do we think about the risks that we don't fully understand yet? And they are appearing all the time, and I'll talk about more of some of those when we talk about carbon specifically. So last year, I got pretty bored of people talking about insurance's role in de-risking projects, and we can enable the transition in a very vague way, because unless we get specific, we can't solve problems. And so working with the Sustainable Markets Initiatives, which is something that was founded by now King Charles in 2019, we worked with CEOs from 40 of some of the largest heavy industries, you can see the industry on the right-hand side, to understand how they think about risk with project. And we developed the following risk landscape. Now, I know this looks like an eye chart. I apologize for that. It's on our website. You can help yourself to it. But this is a risk landscape that what we've tried to do is identify all of the risks throughout a project, thinking about the life cycle from financing and planning stage through to FID happens just about there, the final investment decision, through to construction, operations, and later life. Because our hypothesis was that some projects weren't even getting to FID because they hadn't been sufficiently de-risked. So we thought about projects in those 4 time horizons and then looked at them through the lens of strategic risks. Now, in a commercial sense, in a commercial environment, strategic risks are not conventionally insurable. One of my roles is I lead our energy and power business, and the number of times I've had oil and gas companies ask me if they can insure drilling a dry hole. No. That's why you buy the stock in the company, that's why you employ the best geologists. That's a strategic risk. It's not a hazard or an accident or a fortuity where insurance works really well. But there are some areas you can see, hopefully you can see the colours. In grey, things that are in grey we're showing as areas that conventional insurance that can work, and things that are in green are where non-conventional insurance can work. So once we'd looked at the strategic list, and I'll read a few in a moment because I don't suppose anybody can read from where you're sitting, we thought about the financial risks. Again, the area that banks normally play in, but I've already talked about credit risk, credit insurance. There are financial risks such as revenue. Generally, you can't insure your revenues. That's what your business strategy is there to deliver. But insurance can do something. So if we think in Vietnam, the majority of wind farms in Vietnam buy insurance that if the wind doesn't blow, they protect their income streams. So if there are certain circumstances in which we can put insurance in place that protect revenues, allowing projects to be financed, allowing them to debt to be raised. We then think about operating risks. Operating risks is where people routinely think about insurance. You think about damage events. So we need insurance to evolve for the technologies we don't yet understand. But we also need to think about the other areas that insurance can step into, such as supply chain risks. We're seeing more and more financial consequence of supply chain risks. So I think it was, I'm going to say 2 or 3 weeks ago, a large US auto manufacturer published that they had a $1.5 billion loss due to flooding in their supply chain, resulting in a shortage of aluminium for one of their flagship cars. So how can insurance support the supply chain as well? We then think about the reputational and the liability risks, and also geopolitical risks. We see geopolitical as also being a barrier to finance. A project we worked on recently in Egypt, the lenders were concerned about the political risk of the project, and it wouldn't have been financed unless that could be insured. So across all of those dimensions, we see risks. Now, I'm going to struggle to speak and talk to the mic, but we're talking about risks such as lack of confidence in the viability of new technology. I'm sorry you didn't, is this on? I'm sorry you didn't have one of these. This is so much easier. Thank you. So insufficient confidence in the viability of a new technology. When we talk about carbon markets, this is key, because I'm not just going to talk about nature-based solutions. But if we think about the engineered solutions, the technology that we need to capture industrial emissions is very immature, and we don't have good technology for capturing emissions for all types of processes. And so as those scale, we're going to need insurance for insufficient confidence in the capture technologies that will hopefully allow them to be invested in. I've talked about revenue volatility already, but you'll also see there are a lot of risks here that aren't insurable. And the reason I think it's really important to flag those is because that empowers you to find alternative solutions. We don't have a solution to delays in siting and permitting process, one of the biggest barriers to transition we're seeing at the moment. We don't have an insurance solution for a lack of available talent pool. Again, you need other strategies to think about that. So this is available on our website. Help yourself to it. Use it in any way that it can benefit your business to figure out where insurance may be able to unlock projects. So if we take this framework and then apply it to carbon markets, and again, I'm thinking about carbon markets, the voluntary carbon market in its broadest terms, so engineering as well as nature-based solutions. We start to think about the various actors, whether it's the investors or lenders, the developers or the off-takers, and the risks that they're trying to manage. And so how can we provide insurance for those components? And I'll talk about a case study in a moment where an investor would not lend against a Microsoft project without insurance being in place. And I think most people would consider Microsoft quite a good credit risk, but it required insurance to get the project over the line, and that was an afforestation and nature-based project. There's quite a lot of concerns in some circles about fraud because we don't have integrity in the market yet. We don't have some of the infrastructure that I know MAS is working on. But until that infrastructure is in place, a lot of companies, and our company included, we've been carbon neutral for 10 plus years. I can't remember how long, more than 10 years. This is something that we really worry about, the quality of the carbon and that we're buying well. So we worry about fraud risk as a corporate. For the developers that are making commitments, big risks around non-performance and physical risks. Now, when we think about the nature-based solutions, we think about trees burning down, we think about the trees not growing, but we also have the issues of the industrial emissions with the capture systems not working. So a whole range of concerns for the developers themselves. And then I gave an example of my company, Marsh. We're an off-taker. We worry about quality and additionality. We worry about invalidation and reversal. None of us want to say, I can proudly say that we've been carbon neutral for more than 10 years, but significant reversals may change that. And I promise you, we don't have anything in our budget to buy back to carbon neutrality if we were to discover reversals. So a whole range of issues that the various actors are trying to navigate. So the insurance industry has innovated. Now, if there are any developers, financiers, or off-takers in the market, what we want you to be is demanding and tell us where your pain points are. Tell us what you need to innovate, what we need to innovate. I'll talk through 3 examples. I'm going to start at the right-hand side because I've already mentioned this already, the Microsoft project. It's in the public domain. Microsoft have been very transparent about it. But there's a project called Chestnut, which is an afforestation project in California. And they're looking to, the first phase 1 is afforestation of 60,000 acre project. Microsoft was the sole off-taker, but the lender, also in the public domain, does it say it on here? JP Morgan would not lend unless an insurance was in place against the permanence of those of the carbon that had been captured. And what's really interesting is that the Chestnut had alternative sources of capital, but the cost of debt from JP Morgan plus the cost of insurance was the cheapest way to get this project across the line. So insurance really did support a development there. I'm going to go to the left-hand end now and talk about off-spec CO2 liability. Traditionally, when we've been capturing industrial carbon, we haven't really cared about the quality of it unless it's being used in food products. If it's industrial carbon dioxide that's going into manufacturing, no one's cared about the quality. Now that we're looking to transport it and store it, the quality matters. off-spec CO2 can lead to, if you have moisture in your carbon dioxide, it can lead to accelerated corrosion of your pipes. Carbon dioxide is in fact explosive. You may not think it is, but when it's contaminated, it can be. And so we're now creating ecosystems where we could have multiple emitters commingling their product, putting it into a pipeline that then gets stored. Now, the reason I'm going into the detail is because it's these kind of details we need to get to understand the barriers to project. Because understanding where liability sat for that off-spec product was stopping deals from happening. Because who would take liability if the entire system needed to be flushed because there was off-spec product? Or who would take liability if an emitter could no longer produce their product because the pipeline system was closed due to off-spec product? So there was no ability to capture their carbon. So we've created an off-spec CO2 liability policy that it doesn't matter which player you are in the ecosystem, whether you are the emitter, the shipper of the carbon dioxide, or the sequester, that covers that liability, allowing people to contract. And then finally, I've put on the slide an example of a fraud policy that protects specifically for fraud if any carbon credits are missold. So I realized that was a journey through transition insurance into carbon insurance, but our market is innovating. We just need you guys to tell us where your pain points are, and I promise we will rise to the challenge. So thank you very much, MAS, for the opportunity.
Thank you, Amy, for showing us what insurance solutions are available across the carbon credit value chain. And I'm really excited to hear about the different case studies that you have as well. Thank you so much. As we have heard from both speakers, the hallmark of a successful carbon market lies in strong demand, and that demand cannot be built in isolation. The last half an hour has reinforced the importance of collaboration, innovation, and integration across the ecosystem to drive a credible transition. And it is precisely this kind of innovation and partnerships that we need in order to scale high-integrity carbon markets. To support the development of Singapore's carbon market, MAS has recently launched a 15 million Singapore dollars financial sector carbon market development grant that is aimed at building market capabilities and catalyzing innovation. More information can be found on the MAS website.